All right, friends, we are moving on to the accounts receivable balance, powering through, having a good time. And we see here that we are back to our balance. Remember, we have balances, we have transactions, and then we have presentation and disclosure. Here, we're back to existence. Like I said, we've got the same exact block of text here. And again, we're just going through one after another. We had revenue. The revenue is going to consist of sales and accounts receivable. Then we're going to deal with our expenditure cycle. That is going to deal with expenses and AP. Then we've got cash. Powering through, having a good time. I'm having a good time. Play some music in the background if that helps as well. I didn't think putting music to the back of my lectures would be a very good idea because obviously we've all got different tastes in music. However, I do love listening to music, and I think it's very helpful. Next up here, verify the existence of AR. Really, just as I mentioned before, sending confirmations. These accounts receivable confirmations, like I said, it's a form. And you're auditing your client, you're going to get a list of all the receivables, which are all the amounts presumably owed to the client, and you're going to send them to the customers. And you're going to try to hopefully hear back from those customers because the customers are going to, they're independent third parties. They're going to say, oh yeah, I actually do owe your audit client X amount of dollars. And that's accurate because it would be very easy for the client to just write and create a bunch of fake sales, a bunch of fake receivables. And what are receivables? They're assets. So there's an inclination to want to overstate assets. Next up here, completeness. Really the difference here, completeness is going to be making sure that all transactions and accounts that should be included are actually included. And what are we going to do here? We're going to trace the sales register selections. So we're going to look through all of the listings of the sales transactions. Just go into the accounting records in the general ledger, and we're going to find all the sales. Now we're going to sample that, and we're going to pick some. Those are our selections. And we're going to try to trace those to the specific listing of AR. This is really just the same process, like I said about the journal entries. For every increase in AR, you should have a corresponding sales increase, and you're going to find the recorded sale listed as a receivable. Debit AR for $10,000, you should find a corresponding credit for $10,000. Nothing too wild there. Make sure you're taking notes here. These are incredibly insightful, incredibly important. You're going to see a lot of sims, a lot of multiple choice questions on everything. Next up, we're going to deal with occurrence. Well, with occurrence of accounts receivable, what are we going to deal with here again? Making sure that it is in the proper period and have been properly recorded. Really just, again, going to deal with confirmations. Like we said before, you can have multiple procedures that are going to deal from multiple assertions. So we see that our confirmations are going to help us with existence and with occurrence. Now, one note, I just want to make a point here. Those accounts receivable confirmations actually wouldn't really help us with completeness. We think about that for a second, because if there are any, so like, how do we send confirmations? We look at a list of all the receivables, receivable 1, 2, 3, 4, 5. If there's a receivable missing, well, we wouldn't really actually know that it's missing. So we would not be able to, the form is sent based on a list. And if something's missing from the list, well, we wouldn't know to send a confirmation there. So as such, right, that's just a concern. That's definitely something to watch out for. So just remember, while the confirmation forms are going to help with existence and occurrence, they're not going to help with completeness. And that's something you could see in a multiple choice question. Also, I mean, I wouldn't just say it as a fun fact. It definitely is something that could be asked. Dealing with valuation, allocation, and accuracy, right? So, I mean, if you're not familiar with kind of the whole process of accounts receivable write-downs, bad debt expense, allowance for doubtful accounts, that's not really something that we're going to cover here to much extent within auditing. Obviously, we've got that in FAR, so I would recommend checking that out in FAR. It's tested heavily there. Going with the understanding that you're familiar with that. But the process of writing down, we record bad debt expense with when we know or we expect we're not going to receive an accounts receivable, right, which is money owed to us. So that's very important, because if we are recording $10 million of accounts receivable, and then internally we know that one of our customers went bankrupt and they owe us $5 million, we actually have to write this down to now we are only owed $5 million. And that $5 million is obviously a very big difference in valuation of our receivable. The journal entries and all that, obviously, like I said, that's more of a FAR concern, but this is the gist of it, something to watch out for. And a big deal with that is going to be reviewing the credit ratings of customers with delinquent accounts to ensure that receivables listed on the balance sheet are stated at their true net realizable value. Looking at customers with delinquent accounts, as in customers that haven't really paid you, If you're going to review them and say, okay, wait, this customer actually has no way to pay you, that's probably a big concern, right? And if they have no way to pay you, the net realizable value, the way I like to describe this is what is the value of something net of any costs that you will actually realize. So generally in FAR or in BEC, you'll see this as the selling price minus the cost to sell. Well, the net realizable value for AR is going to be the amount you should receive minus what you won't receive, right? So again, looking at the credit ratings of customers with delinquent accounts, which are those who are seemingly not paying you, to make sure that the proper write-downs have actually happened. Next up, evaluating the adequacy of the allowance for doubtful accounts by reviewing the entity's accounts receivable aging schedule, which allows the auditor to see if certain receivables should be written off and thus affecting the asset value. If something is outstanding for 300 days, it's probably not going to get paid. If something outstanding for a full year, you're probably not going to receive that money. And as such, you should write it off, which is the same process here. You would write down your asset, which it's not good for a company. And as such, presumably why they wouldn't want to write it down. Next up, using analytical procedures on invoice amounts, sales order quantities, and customer account identification to perform substantive tests, just verifying the accuracy of those sales. Sales and accounts receivable are going to go hand in hand. And if there is a problem with the sales numbers, there could be a problem with the AR numbers. So you want to make sure that you're going through the whole process. Like I said, a great way to just ensure that all the numbers with the whole revenue cycle are accurate are just go through the normal sales process. That's a test of internal controls, which would help you very much in auditing this. Let's talk about rights and obligations. Really, the kicker here. Now, just actually, quick note here. We didn't see rights and obligations when it came to sales. And why is that? Rights and obligations generally have to do with assets and liabilities, balance sheet. Do you have the right or obligation for your specific sales transaction? No, a sales transaction is not a physical thing. It's not an asset or liability that you might have a right or obligation for. So just keep that in mind. Now, unearned revenue, that's a liability. So there could be obligations there, right? So just making note of that. That's why we see, for example, we'll see, and this goes back to the chart we saw originally at the beginning where we saw different assertions as they related to both AR and sales. But here, we're going to see rights and obligations, again, because AR is an asset, whereas sales is a revenue account on the income statement. The rights and obligations assertions are concerned with assets and liabilities. On the balance sheet, rights means that the assets are not pledged as collateral, they're fully owned, and they're not subject to a lien, which big reg word there. You can see that in regs, a lot of talk of tax and tax law, business law, contracts, agency. God, if I'm saying all these wonderful topics that you know from reg, then I hope I'm not giving you too many nightmares. But essentially, like, does someone else have the rights to your asset? Like, is someone going to come in the night and try to collect your car because you weren't making payments on it? If any assets are not fully legally owned, this should be disclosed, right? Like, for example, you may, if you have a house, God, I don't think I'll ever own a house because, I don't know, people in my generation, it's just kind of the giving up on the prospect of ever owning a home. Things are just a little too expensive. But for those of you who have a home or you understand the concept of having a home, you get a mortgage, and if you put 20% down, that means you only own 20% of your house. The rest of the 80% is owned by the bank. So this should be disclosed, and the assets may have to be reclassified. Obligations means that all liabilities owed by the entity are properly accounted for, and that any potential liabilities are identified and accounted for in a timely manner. Now, how would you actually test rights and obligations of AR? You're going to send confirmations to those customers listed as owing the receivables and receiving the confirmation forms back. That's one way to obviously make sure that you have the rights to that AR. But also, you're going to need to, and this is something not included here because we'll see it later, but reviewing contracts. And we saw this actually also on the chart earlier. You're going to review any contracts outstanding because let's say you borrowed $10 million. Gosh, I just love the $10 amount, right? It's just very clean, very nice. Let's say you borrowed $10 million from the bank. Now, maybe you pledged your $30 million of AR as collateral, meaning if you don't pay back this loan of $10 million to the bank now has the rights to your $30 million of IOUs to you from your customers. That's something that can easily happen, right? Like, for example, lines of credits, if you've got, this is something that I don't know if any of you have encountered, but personally, you could go out, take an investing account. If any of you have heard of borrowing on margin, let's say you have $100,000 in an investment account, you might be able to borrow up to 30% of that at a certain interest rate, and it's usually a decently cheap interest rate. And why is that? Well, because you borrow it from the company that holds your stocks, and if you don't pay them back, they just take your stocks, right? So that's why you generally also want to pledge collateral. For example, why are credit card rates so expensive? It's because the credit card company can't physically seize your assets if you don't pay them back. But car rates are a little bit better. And why is that? Because the car company or whoever you are financing the car through, they can come and just take your car if you don't make those payments. But anytime you're pledging an asset, it's beneficial because also you're able to get financing, but probably get a better rate. It makes creditors feel better. So that's kind of this concept, right? If you pledge those receivables, that is something that you need to properly disclose because you may not technically own them anymore. This is something that's really we talk about a lot in BC. I love just connecting all the exams together and making notes there. Now we're dealing with the understandability, presentation, disclosure, classification of AR. Let's see what we've got in store for us here. Well, how would we test the presentation and classification of AR? We want to make sure that all receivables are properly recorded. Now we can obviously classify AR between their collectability. As we mentioned, we've got bad debt expense, allowance for doubtful accounts. We've got classification. We've got 30-day AR. We've got accounts receivable that may be coming in 120 days. Also, if we have entered into a long-term contract, maybe multi-year contract, obviously that could deal with classification of receivables based on the year. Next, we can examine supporting documents for receivable transactions, look at any documentations, get any detail on any of those, confirming the accuracy of the balance. Obviously, a lot of the actions that we've taken in the prior assertions are going to help us with the presentation and classification here. Checking that receivables are properly classified as long-term or short-term. That's another great way. Obviously, again, like I mentioned, if it's a long-term contract versus a normal 30-day sale, that's something that we could properly classify. Next, assessing the reasonableness of the allowance for doubtful accounts. Is it reasonable? There's a significant piece of judgment when it comes to this. A lot of times management is going to judge and determine, hey, what is our amount for allowance for doubtful accounts? How much do we expect to not receive? You, as the auditor, should go in and test the reasonableness of what management assesses they are not going to receive. Obviously, management probably has an inclination to want to say, oh, yeah, we're probably going to receive most of it, because if they do that, then they can write up their AR as much as they want, make their assets look stronger. Next, determine if any receivables are past due. If anything is past due and it's not listed as such, that would be a problem, and you want to make sure that's properly classified. Lastly here, reconciling AR with the general ledger. That is going to be pretty important there. Making sure that your accounts receivable aging schedule, which should have all of your AR listed out, it matches what you have listed on the general ledger for the AR balance. All right, let's talk about. We're going to dive into AR more specifically. I know we have our normal format of going through. We've got sales and then AR, talking about the assertions here. But we're going to talk more about accounts receivable in general. Just how does it work, the processes, the cycle. While selling to customers on credit is a standard practice in business, as we mentioned, it's crucial for a company to have a credit department which conducts credit checks on all new customers and regularly reassesses, whether it's monthly or quarterly or annually, existing customers' credit worthiness. If a customer purchases from the audit client and cannot pay, the company will have to write off the receivable and they are going to lose that cash and revenue. We are, let's say, ABC company over here. We're a manufacturing company. We are going to produce different storage units, right? Different fixtures for other companies. Now they're going to buy it from us, right? Maybe Walmart buys from us. Maybe Target buys from us. All of these are our customers. They're going to buy from us. And you might think, okay, Walmart and Target are reputable companies. Sure, sounds good. I don't know. Maybe you're watching this a year in the future and one of these has gone under. Maybe. I hope not. I don't know. I've had good experiences at both. So anyway, we are going to say now there's XYZ company. Let's say this company is not as reputable as these other customers. This is a customer that you're possibly going to sell to. And maybe in general, your credit department, there's a whole department of people working for ABC company, which is the audit client. They determined that originally XYZ company is a solid customer. However, let's say after a year, they determined, well, XYZ hasn't been paying their other bills, so why would they pay us? So we're not going to sell to them anymore. Now, another concern we have, and we'll see this just throughout, our salespeople, right? We have a whole sales department, and they get paid on commission. So the more they sell, the better. Those salespeople actually, well, they should be working for the benefit of the company, right? Every employee should be working for the benefit of the company. However, if those salespeople have a significant personal incentive, they could try to oversell to customers who they probably shouldn't sell to. So they get paid commission based on the sales when it happens. And now some companies do it differently. Some companies pay their salespeople when it's actually collected, so salespeople can't just make a bunch of sales to sketchy companies, collect commission, and not worry if the company's ever going to receive that money. But obviously, so that's just me kind of going on a little description of how it works in the real world. But that is a concern, is that a company's salespeople kind of go crazy, overstate the AR, and they sell to a bunch of companies that probably won't pay it back, and their financial statements are in shambles because you're not really going to ever receive money from any of these kind of less likely to pay you back companies. Now, if an auditor notices that the audit client has bad debt expense, which is unusually high as compared to similar companies in the industry, this could be indicative that the company does not conduct credit checks on new customers or does not conduct this process well enough. So similar situation here. If the audit client, if ABC company has a very high bad debt expense, which is when you're actually recognizing, writing off these AR balances, meaning you're realizing that, hey, they're actually not going to pay us, that could be indicative, like we're not doing a good enough job assessing the creditworthiness of these potential customers. Let's talk about positive and negative confirmations of accounts receivable. What we talked about so far, we talked about this form, right, that you send to customers. You look through a big list of all the accounts receivable that the client has, and you send this form over to their customers. And this form is going to say right here how much you owe the client, and then sign here. Now, there's different ways of making these forms, and that's what we're going to talk about here. We have positive and negative confirmations. Now, positive and negative confirmations, they're a common auditing procedure, right? They assess the accuracy of the company's accounts receivable. While the client may prepare the confirmation forms for independence purposes, the auditor is the one to send it. Why is that? So the client prepares the forms, it's on client letterhead, but the auditor needs to send it because the client could mess with it, edit it, something like that. So the auditor is the one who needs to receive that. Now, positive confirmation, this is a letter sent to the customer of the audit client asking them to confirm the validity of an outstanding balance. So here it could say one thing, it can say, hey, it says here you owe us $1,000, confirm that. Or it could actually leave this blank. Now, the difference there, and we'll talk about this more and more, if on this letter it says you owe us $1,000, please confirm that, that's easier for the customer to just say, oh yeah, I owe you $1,000, sure, and send it back. However, if you leave this blank, the customer has to write in how much they owe you. That's actually going to be more accurate because it's more work for the customer, right? So the customer has to go into their accounting system and see how much they actually owe you. Now, that's going to give you a more accurate balance because it's more work for the customer. But on the flip side, negatively, that could also mean that you'll get less responses because the customers have to, take more time out of their day. Audits are annoying, as I mentioned before. Like just higher budgets, higher time spent. So different pros and cons to each. If you include on this form and says, oh yeah, hey, XYZ company, it looks like you owe ABC company, which is our audit client, $1,000. Again, if you include that dollar amount, it's going to make it easier and you're more likely to hear back. However, if you include it and it's blank and XYZ company has to fill in the blanks, that's going to give you a more accurate result. The letter is going to usually include the amount of the balance and the date of the invoice. The customer is asked to respond by signing and returning the letter confirming the amount due. Obviously, you may not hear from the customer. Positive confirmations provide more assurance. However, you're less likely to hear back from them because they require more work on the customer's part. Negative confirmations, you're more likely to hear back. Or actually, you're not really likely to hear back. We'll talk about what this is, but this provides less assurance, and we'll see why. Negative confirmation, on the other hand, this is a letter sent to the customer of the audit client asking them to confirm that there is no balance due to the company. So it's different. So we see it's kind of similar to positive assurance and negative assurance, as we've seen throughout the course. Positive assurance is you providing reasonable assurance, you're doing your work, right? Saying we're reasonably certain that there's no material misstatements. However, negative assurance says we are not aware of anything that is not in compliance or not materially an issue right there. So big difference there. This is asking them, like I said, to confirm that there's no balance due. The letter will usually include the amount of the balance and the date of the invoice, as well as a statement that the company does not expect a response if no balance is due. So you're not going to hear from them. And if you don't hear from them, you assume that everything's fine. Now, a customer should write back if there's an issue. But maybe there is an issue and the customer just doesn't write back because they ignore you. It's just too much work. So you see the issues here, the intricacies. And this is kind of like the pros and cons, the cost benefit analysis of how much work you should do in order to conduct your auditing procedures. It just depends on how much work you're willing to put in. The customer is asked to respond by signing and returning the letter confirming that no balance is due. AR confirmations can be sent either on customers' individual invoices, right? So if Walmart consistently buys from you, we are ABC company, and Walmart makes multiple purchases a month from us, you could send confirmations. You could send confirmations for each individual transaction that Walmart does, for each individual outstanding balance, or you could send confirmations for their total outstanding balance that is owed. Two different situations. We'll kind of talk about the pros and cons of each. If the auditor decides to confirm the whole AR balance, the response rate could be improved by including a list of items or invoices that constitute the customer's account balance on the confirmation form. Now, Walmart here, right? Walmart has accountants that are going to end up responding here. Let's say, obviously, it's probably going to be a lot more, but they have 3 transactions. One is for $1,000, and then one is for $3,000, and one is for $5,000. So these are 3 separate purchases, and we put these all together. We get a total of $9,000. So the auditor can say, all right, we're going to send 3 separate confirmations for these each transactions, or we could send one for a total of $9,000. Either way is okay. You just got to remember that there will be different outcomes based on what you choose to do. Obviously, individually doing it is more work for Walmart's and accountants. So if you do it together, that's just another process to do it. If the customers are provided with the information that they need to verify, it would be less work for them and they would be more likely to respond. On the other side, providing a blank form, as we mentioned before, would reduce the effectiveness of this procedure as more effort is required by the recipient. However, if the auditor is concerned about recipients carelessly signing off on the forms, so if Walmart's employees are just like, all right, I don't really care about this audit, like it's their audit, it has no bearing on us, just check it, cool, send it back. A blank form would increase the quality of responses. If AR are confirmed as of an interim date and there are no red flags raised, at the end of the year, the auditor should review supporting documents for new large balances occurring after the interim date and evaluate any significant changes in balances at year end. This goes back to our interim testing, which we've got in another lesson. Essentially that concept, right, that you're testing at, let's say, 6:30 instead of 12:31, testing halfway throughout the year. And this is what you would do. So essentially saying you've done enough testing by interim. Now, in reality, you're going to test the entire year. This is just textbook accounting. This is textbook auditing, saying that as of the interim date, everything looks good. And then you're going to examine and see if there were any other large or unusual balances occurring after the interim date and before year end. Moving on here, really going into depth, and this is going to basically touch on anything you could be asked in the exam about confirmations. One point I'll keep in mind, and we'll see this when we get to cash, a lot of this applies the same to cash confirmations. So while in order to confirm the accounts receivable balance, you send these confirmation forms to the customers, if you want to confirm the cash balance that a client has, you'll send these forms to the bank. Now, they're different forms, obviously, similar in concept, but in practice, they're different. They're confirming the cash balances. If the client has 5 different bank accounts with 5 different banks, you'll send forms to those 5 different banks, verifying the cash balances that they actually have with the bank. So just keep that in mind, is that it's a very similar process, same intricacies where if you keep it blank or if you include the balance on there, it has the same implications of cost-benefit analysis. Now here, the auditor uses the accounts receivable detail listing, so just the listing of all the AR specific transactions they have from the client's records as a population to draw the sample from. Again, in the accounting system, they just got this big old list, receivable transaction 1, receivable transaction 2. The auditor then sends confirmation forms to the sampled customers. The auditor is required to confirm AR balances if they are material. So that's just something that you got to take into account for any audit. Additionally, to possibly avoid the audit client tampering with responses, confirmation forms should be sent directly to the auditor. We mentioned before, the form is from the client, but the auditor sends it and then the auditor receives it as well. Now, per the AICPA, for the purposes of the exam, having the original confirmation forms mailed to the auditor rather than being emailed or faxed is less risky because per the AICPA, and I obviously keep pointing out per the AICPA because I kind of disagree. I mean, especially these days and age with technology, it's possible for electronic responses to appear as if they came from the customer, while in fact being falsified responses generated by the client. So, for the AICPA, physical mailed forms are best because the client could presumably fake being a customer and email it back to you and edit it and tamper. Now, in reality, I think there are good enough softwares out there. I mean, there's even a website called confirmation.com that most big firms use. A lot of different ways to combat that. But hey, I'm here to teach you how to pass this exam. I'm not here to, lecture you on how it actually should be. Let's get you past this exam, moving on with your life, and having a great day. If electronic responses are received, or if the confirmation is sent to the client first before the auditor receives it, the auditor can call the customer to confirm the results of the confirmation form. But this is just what the auditor should do if this situation arises. Now, again, as I mentioned, a lot of this is different from how it may be in reality, and just in general throughout the exam, there may be a lot of you who have worked in audit and you're pulling your hair out saying, "Nick, this is just not how it works in real life." And to that, I say, "Hey, man, hey, I didn't write this stuff. I'm just here to teach you how to pass the exam. I'm just trying to get you done, trying to be able to help you to move on and become a CPA." All right. Let's see what we got here. AR confirmations would not provide evidence for the completeness assertion because customers would likely be incentivized not to report understatement errors on their owed balances. Let's talk about that for a second. Interesting point because as well as we said, AR confirmations do not provide the completeness because, well, if there's a missing AR transaction on this listing, you're not going to know who to send that. There's no one to send it to. You just are not going to be able to test for that. Additionally, if you are sending these confirmations to customers, so again, we are ABC company and we're sending it to XYZ company, which is the customer, and ABC company is the audit client, they record that XYZ company owes $10, but in reality, maybe it was an error and XYZ company actually owes $100. So because of an error, ABC, which is your audit client, underwrote how, they wrote incorrectly how much was owed. So XYZ is like, oh, damn, okay, well, they messed up. Sucks to be them. We're not going to respond back to this letter because if we do, we're going to have to actually prove that we owe them $100 and we don't want to do that, right? We want to pay them less. So it's kind of, everyone stands up for themselves out there. XYZ company's not going to shoot themselves in the foot and pay an extra $90 just because ABC messed up. So that's kind of why that's could be a multiple choice question. Also, just an interesting point that you could see on the exam. As a brief note on AP confirmation, because we've talked about AR confirmation, we'll see AP confirmation when we get to the expenditure cycle, but they're not really utilized to the extent that cash and AR confirmations are. The auditor would use a population of the vendors with whom the entity has done business with in the past and send confirmation forms inquiring if any amount is owed to the vendor by the client. Let's think about that for a second, right? Because the client will have a list of people that owe them money because, well, guess what? They want to report as much assets as possible, as many assets as possible, as many receivable balances. However, the client has, incentive, management has incentive to possibly understate expenses and understate AP. So their list of who they owe everything to might not be complete. And as such, you as the auditor, you're going to have to just, any common vendors that they usually work with, yeah, you can send confirmation forms and say, hey, on this form, is this what they actually owe you? Do they owe you more? But if the client decides to exclude a bunch of vendors from their listing, on their AP listing, you can't really find them, right? Like it's not like you would have a complete listing to actually sort through. Now, the use of positive and negative confirmations helps to verify the accuracy of the accounts receivable balance. Perfect, makes sense there. This is especially important for long-term accounts receivable as it helps to prevent errors from being carried forward from one period to the next. Additionally, positive and negative confirmations can provide important information about the customer's payment habits, which can be used to improve collection efforts. Right? As a reminder, we are the auditor. We're acting on behalf of the client. Well, we're not working on behalf of the client, but we have essentially a fiduciary duty to the client to, help them where we can, as long as it doesn't impede our job with being independent and providing an opinion based on that and reasonable assurance. So if we can reasonably just help the client and say, hey, we did this analysis and we did a bunch of accounts receivable confirmations, and we could say, this is how you can improve your collection efforts. for the ACPA. And I mean, just think about it out of decency. You should help them to improve their processes, right? Obviously, you've got a lot of experience here in auditing as time goes on. If you see a way that your client can improve, you should help your client. Just be a good person out there. Negative confirmations would most likely be used when the combined assessed level of inherent and control risk relative to AR is low. Like we said, negative confirmations provide less assurance. So if you have a lower risk there, then you can use these, right? Because it's less work, it's less assurance. If control risk is high, then positive confirmations would likely be sent. Makes sense. Positive confirmations give you more assurance. If risk is high, send more. The auditor has no reason to believe that the recipients of the requests are unlikely to give them consideration. So, negative confirmations would be used if the auditor is very confident that everyone they're sending to are going to accurately respond to them. And then, lastly, there are many small balances owed rather than a few large balances, which would make it difficult to keep the more time consuming and costly positive confirmations to a reasonably low level. So, if there's just so many balances out there, it's easy to click send on 1,000 documents being sent rather than deal with possibly, like, if you have a few large balances, if you have three $10,000 transactions, that's a lot easier to do the more costly positive confirmations. Whereas if you've got 1,000 small transactions, it's easier just to send out all these negative confirmations, right? Cost benefit analysis when we decide what audit procedures we're going to do. All right, here is just a nice recap as well as a few additional points on the benefits and the pros and cons, right? The negatives, disadvantages, advantages of positive and negative confirmations. Well, positive confirmations, remember, these are the ones that are going to provide more assurance, but they're more costly and time consuming, and you might not hear back from someone because it does take more time out of their day. These can provide valuable information that may not be available from other sources, such as customer payment terms or changes in customer contact information. Right? If you send out this form to a customer, they may respond and say, "Hey, our terms are actually this," or "We actually changed." This is essentially getting in touch with the customer, so that can be helpful for the the audit client. Right? Contact information can be updated. These can also be used to verify the accuracy of customer balances and identify any discrepancies. Perfect. Now, what are the disadvantages here? The process of obtaining positive confirmations can be time consuming and costly, as we mentioned. Lastly, customers may be reluctant to respond to these confirmation requests because it takes time out of their day. And just think about it. You're working as an accountant, you're overworked, you're working for Walmart, and then ABC company reaches out to you and says, "Oh, I want you to respond to this form." You're like, "I got a million things to do. The last thing I want to do is respond to an audit client of someone else. That just has no impact or bearing on me. So I'm going to ignore this." What are advantages of negative confirmations? Well, these are less intrusive than positive confirmations and can be less time consuming and less costly. Right? Well, what is cost here? Time is money. We are a service oriented business. We are an audit firm. So the more time it takes us to do these testing procedures, the more cost. Customers also may be more likely to respond to negative confirmations than positive ones, just simply because they're less time consuming for everyone. The disadvantages here, they do not provide the same level of assurance as positive confirmations. All right. They may not provide the same level of detail as positive confirmations, right? We just know they're less effective there. They may not detect changes in customer contact information or payment terms. Lastly, the auditor cannot infer that all non-respondents have verified their account information. Essentially, remember, they're just saying respond if there's something incorrect. And you can't infer that everyone's verified. So it's easy to just blast out a bunch of negative confirmations, and maybe you do that in addition to sending out positive confirmations on the material balances. Different auditing procedures to see through. All right, let's talk about non-responses to AR confirmations. If you just don't hear back, what do? Do you panic? Do you just abandon ship? No, let's see what you do. Well, if an auditor is faced with non-responses, so you're sending out these forms, no one's responding, or just maybe some people are responding, but what do you do about the ones that you don't hear back from? The auditor should take steps to investigate the issue. And like I said, remember, you need to confirm all material balances, so that's you can't just give up ship right there. You got to actually do something about it. So first, the auditor should contact the customer to determine why the confirmation has not been sent and to request that it actually do be sent. Say basically just following up. Hey, I sent you this. I don't know why you didn't follow up. Do you hate me for some reason? Respond back. The customer does not respond. The auditor should contact the customer again and document the attempts that have been made, right? You're trying to just do what a reasonable person would do. Document the procedures, document the attempts you've done. So, if anyone questions, hey, why didn't you hear back from them? You're like, well, I reached out 15 times. If the customer still does not respond, the auditor should determine the risk associated with the non-response. If it's a smaller, lesser material transaction, maybe it's not as big of a deal, right? Let's just think about that. The auditor should consider factors such as the company's relationship with the customer, the size of the receivable, and the age of the receivable. Just how risky is it to maybe just let it go? If the auditor believes that there is still significant risk associated with the non response, they should consider the materiality of the unconfirmed amount. As with all procedures during an audit, this is very much true. We've got a lot of procedures. We have a concept of alternative procedures. So, if the primary method of gaining assurance, which in this case is confirmations, if that's your go to best testing thing for AR, right? Per the CPA, per just common sense, confirmations are the best thing to do. But if that doesn't work, then you should attempt alternative procedures. There's for everything, whether you're testing debt, cash, anything, there's always a way to perform alternative procedures to test it a different way, right? Maybe you're trying to get actual statements on on how much the client paid out in interest expense throughout the year. And if you can't get those statements, well, maybe you recalculate interest expense and you look at other possible documentation that can help you gain assurance over interest expense. What are some common alternative procedures here? Well, you could examine shipping documents and sales invoices to determine that the inventory was actually sold. Right? As we mentioned, there's a lot of documentation. Some of it, for the purposes of auditing, is redundant. Like some of it is just going to prove again and again that this actually happened, and that's great, right? Because we take a look at it. Also, verifying the AR balance by inspecting the client's bank statements and cash receipt records for subsequent cash receipts. So basically, if you don't just confirmations are a nice, easy way to just confirm it because you're hearing it from a third party who has no reason to possibly lie, hopefully not lie. But if that doesn't work, like we mentioned, it's a whole cycle. You could just go through and just trace and vouch everything throughout the entire cycle from the minute they received the purchase order to when they shipped the goods, when they sent the invoice. Just look at everything throughout. And does everything else look good? Then, all right, it's going to be hard to falsify every single piece of documentation throughout the entire process, especially if it's within multiple departments. And as we talked about departments, let's see what the departments look like within the revenue cycle. Now, this is just more general for your understanding of everything. It's not like you need to know these. The terminology can be different in general. It's not like you're going to be asked questions on these, but I want you to just understand how the revenue cycle works. Obviously, like I said, we will see some flow charts on the revenue cycle, and those are coming up. Give us a few more slides. Like we got a lot going on here. There's a lot to go over. I'm trying to make sure that you see everything. And this is just more of the hefty lesson. There's a lot asked from this lesson, so that's why it's so long. Continuing on here, who is involved in the revenue cycle? Well, as we mentioned, first off, you've got the sales and marketing team. This is going to be a department that is responsible for generating leads and closing sales, just getting that business. As we see here, I've highlighted what part of the segregation of duties each of these departments have. Are they record keeping, authorization, custody? And like we want to keep these separate. However, something like sales and marketing, that's just support. They don't have custody of anything. They don't keep records, right? That's the accounting department. And they don't have authorization. I mean, maybe they have authorization over something, but nothing really related to the revenue cycle. And then we have accounts receivable. They are in charge of record keeping. These people are responsible for processing invoices, collecting payments, and issuing credits. Then we have the credit department. This is authorization. Like we talked about before, there's a credit department that's responsible for evaluating customer creditworthiness and setting credit limits. Just as a note, I would definitely memorize the I'll call it the ARC, ARC, authorization, record keeping, custody. That's how we refer to it sometimes. Memorize which department has which responsibility. Next, we have treasury. This is cash. Treasury is dealing with that. The treasurer is dealing with cash. Responsible for managing cash flow, investing excess funds, and managing debt. Now, just keep in mind, within each of these departments, you could have different people that have different responsibilities. So within the treasury department, you could have a treasurer that mainly possibly does the authorization. Then there could be accountants below that person who deal with the actual record keeping. And then within the treasury department, you could have cashiers that deal with the actual custody. However, just in general, the treasury department is going to deal with custody. They're responsible for cash flow, investing excess funds, and managing debt. Next up for internal audit, this is going to be review. Now, like I said, it's kind of similar to support. It's not one of the ARC. This is just their kind of review. It's internal audit, right? They're obviously their job is to audit the company, make sure that everything's going well, and you have external auditors as well. They're responsible for verifying the accuracy of financial statements and conducting internal audits. Internal audit departments kind of apply everywhere. Financial reporting, lastly, here, these are going to be those in charge of record keeping, really the accountants responsible for preparing financial statements and creating reports. This is really just your accounting department. And lastly, here, the departments that facilitate the revenue cycle overlap with those in the cash cycle, as we mentioned a few times. So you're going to see some of these pop back up in the cash cycle.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.